Jaipuria, founder and managing director of Valentis Advisors, joins us now to discuss market fundamentals and his top sectoral picks. Thank you so much for joining us, Jyotivardhan. First up, we've had 9 years where markets have ended in the green. 2025, do you think you can see one more year, or should investors temper their expectations?
Yeah, so I think they should temper their expectations. Hopefully, we end up with a positive year. But the sort of returns we've seen in the last few years, I don't think investors should be looking for that sort of return. I would be hoping that we get like a high single-digit sort of return in the market for 2025. But it will be a tough year. It will be a year where it won't be easy to make money. I think there'll be a lot of volatility which we've not seen over the past few years. So there'll be a lot of ups and downs in the market because there's a new government coming in the US. Will Fed really cut, or suddenly we get inflation spiking again? So there'll be a lot of questions like that which the investors will have to grapple with.
Yes, it promises to be quite a roller coaster. Jyotivardhan, great to be speaking with you after a while. Season's greetings to you. So I think for Indian investors, it's been a double whammy in the last couple of months, right? Because one, you have this whole go back home to America, buy America trade, which is where the FPI selling has come in. And the second is that we have growth concerns here. I mean, look at earnings. We'll probably end some 5-6% for FY25. There's some expectation of recovery later, but let's see how that plays out. You tell us, in terms of earnings, what are you expecting the market to deliver over the next couple of months, and where would you place your bets?
Yeah, so Sylvia, you're right. So for me, valuations were the concern always, but it's more like the earnings in the economy, which is, I think, a bigger concern. And that's why, you see some of this money flowing out also. Obviously, there's a trade which is go back to America and sell emerging markets everywhere. But if the growth had held up, then probably the extent of FI selling would have not been so much. The way we were looking at it is we thought the June quarter numbers were also weak. And at that time, the market was probably ignoring it to some extent because the markets were doing well. The good thing for us is we think earnings from here will probably recover. So we'll see a bit of recovery probably in the December quarter, won't be very significant. But I think come March, we'll probably have a better quarter coming. And there are 3 reasons for this. So one is, we'll see probably spending from the government on the Capex side, which was missing so far. So if you think about it, they spent only 4 lakh crores in the first, 6-7 months of the year. And that, we think it could accelerate. Maybe they could be spending like close to 1 lakh crores a month for the next 3-4 months. So that will help, the demand in the economy. The second thing is the monsoons have been good, the crop has been good, and so rural income will pick up with, that crop coming into the cash for a lot of farmers. Third is the liquidity has been eased. So, that was a big move by the RBI and the credit policy where they cut to CRR by 50 basis points. So that's like more than 1 lakh crores of liquidity which will come in the system, and that will start helping earnings. So hopefully as we get into the March quarter, we will see earnings inching back closer to the 10% range. And for next year, we are expecting earnings to be like more in the 11-12% range. So much weaker than the last 3 years. At the same time, 11-12 will be decent. And so, that provides room for getting, maybe a high single digit or low double digit return in the market.
Right. So Jyotivardhan, H2 you say would be slightly better than H1, and FY26 on also probably aided by the lower base of FY25, you could see some recovery kicking in. Well, we want your view specifically as far as the entire BFSI space is concerned. MFI has been in significant pain, so too the rural. So do you think that particular pocket of the market can recover quickly? Especially, you've seen pain there, so MFIs haven't done well. Along with that, even consumption, updates that have come in from a lot of FMCG companies have been very weak.
Yeah, so the way we work and the way we generally buy, we have this whole 3U's philosophy. So we tend to buy undervalued stocks, which basically are underperforming and underowned at some point. So for us, we've actually started nimbling into the BFSI space. We've been buying some banks which trade at really cheap valuations. A lot of times when this happens is, there is obviously pain in the system, and that's the reason things are trading cheap. So if we just step back and think of valuations, if we do a 10-year valuation for every sector, then we do current valuations, there are only 2 sectors which actually trade at like a cheaper valuation than the 10-year average. And one of them is the BFSI space. So we've been looking at banks buying them. They're obviously, I think the MFI pain will not get over very quickly. I think the MFI pain will continue probably for the next 2-3 quarters. But there are a lot of other things in the banking space which probably should start to recover a bit. Credit growth has been fairly strong. Liquidity has got improved in the system, and the banks are trading very cheap and they've done badly. So at these valuations, banks look attractive as a space where you could make double digit sort of returns in the market. Our selection is more in the smaller cap banks because there are a lot of small cap banks which trade at like price to book of less than 1 time book, and that's why we think the bigger bank can be made. But even some of the larger banks probably are looking very attractive at this stage, at least on a relative basis where the market valuations are.
Okay, so banks, that's one definite go-to place for you. What else, Jyoti? I mean, we've seen a lot of, for instance, we've seen some of the excitement cool down from the PSU pack. We've seen, stocks come off in the Capex play as well. Some of these high flyers, MNC high flyers from, power equipment manufacturers, etc. So anything else, anything in this arena or beyond?
Survi, the Capex plays, they've got re-rated quite a bit. So if you see in the last 3-4 years, the stocks have done well, the re-rating is quite significant. And so there, the risk now is that, at these valuations, you need earnings to come if the returns have to come. And given that government has been slow in spending, it provides some sort of risk. So in that, frankly, we've been nibbling and selling away some of the capital goods stocks with us where, we've done badly and it has done very well for us. One other space we have been quite bullish on is the pharmaceutical space. So in pharmaceutical, there are two areas which we like. One is, the US generics is something we've been playing in a big way because we think largely a lot of the pricing pressure which we've seen in the US generic is behind us. So prices may still fall, but it will be a very, very low and slow fall. And so to that extent, the big drop in earnings we are seeing for anybody who's in the US generic space is behind us. And we probably see these companies growing earnings quite a bit. The other is, the crime space, which has been traditionally area we've liked. We continue to like it. We think, growth there will accelerate for a lot of those companies. And so these are two spaces in pharma which we like and where, they are relatively more immune from any economic slowdown, which, India may have, the world may have. And so, it's something which you can buy and be a little more secularly sure that, earnings growth will keep coming. So I think pharma is one space investors should definitely look out for.
Jyotivardhan, within the pharma space, you gave us two themes. First one, you expect generic pricing erosion to abate, and secondly, you've mentioned the CRAM space. Now, one other pocket within the pharma space that's done very well has been the CDMO space in hopes of the US Biosecure Act coming in. 2024, that hasn't transpired, but within that particular space, do you like anything?
Yeah, so when I spoke of the CRAMs, I was including the CDMO and the whole area, So it was generally like I use CRAMs as one technology, but basically, everything else, the CDMO and even the research-driven outsourcing companies, we like that whole space. And biosecure, like you said, is one area which can further add to the growth. But even if that does not come, basically the growth is there just now because a lot of people are outsourcing to India. I think, in general, for a lot of US corporates, it's like we want to move some of our outsourcing away from China to India. So I think, we'll see that growth coming if the Biosecure Act gets passed, then that will probably further accelerate the growth in this space.
Understood that. Thank you so much for joining us, Jyotivardhan, and wish you a very happy 2025.
Yeah, Happy New Year to all your viewers and all of you.
Thank you so much, sir. Well, time now for a short break. On the other side, we'll tell you why stocks like Seagull, EPAC Durables, etc. are buzzing in trade.